morning, and it's good to see so many of these familiar faces. I know I've sat with many of you in your living room or in a hotel lobby. So my name is Bill Pedersen. I'm an Executive Vice President here at Stansberry Asset Management. Just want to kick this thing off today. I'm going to introduce Austin Root, who's our Chief Investment Officer, and then David Doc Eifrig, who is known to everybody. And we're just going to do a fireside chat with these guys, and I really hope you guys enjoy this. So thank you so much for coming, all of you. Some of you came great distances, some came from a couple miles, but we're just thrilled to see you. So thank you very much.
Thank you. All right, great. Now we do the fireside chat that we sort of talked about we were going to do. And we'll absolutely get questions from you guys as well. But I want to start with a couple. You guys remember the Dos Equis commercial about the world's most interesting man? I mean, that could be you, Doc. You know, got your MBA from Northwestern Kellogg, Wall Street trader at Goldman, Chase Manhattan, Yamiche, is that?
Yamiche, yeah.
Yamiche. Doctor, UNC, a researcher in molecular genetics at Duke, board-eligible eye surgeon, helped start a biotech company that was later sold for more than $100 million to Roche. You appointed yourself chief bottle washer at Eifrig Cellars. I didn't know you were a dishwasher as well. And then, of course, editor, entrepreneur, investor as well. So I think you're uniquely positioned from seeing so many different things, and you've provided us a little thoughts here. Well, I don't know if you had any other thoughts on from any of those experiences that kind of help investors and clients and readers on how to deal with this market.
All of us who have money have worked hard for our money. Money represents, it's a way of exchanging your time as valued with someone else's time as valued. And I would say we're at a time in our world where teaching those values about that and money, that it's not just for money's sake, but it's an exchange of value, sharing some of that wealth, teaching about what is wealth. You know, wealth is not just interest rate, it's investing in local restaurants, communities, whatever it is that you want to invest in so that you have money to share, to use how you want to use it, whether it's to go skiing, hiking, RVing. Money is kind of it's a touchy subject for, folks when they're younger, between parents perhaps, when you're older. I would just, I don't know, I'm kind of rambling, but I guess I feel like when we're at an age where people think that there's value to be had by standing in a line and having the government not, pay you to not work when you're, let's say, a carpenter or an electrician. I just don't understand that. I don't understand where that takes our country. And so that's worrisome, because I've always believed no matter what I'm doing, I can work as hard as anyone physically and would love to do it. And I don't know, I'm confused right now. We can talk about it at cocktails, but.
Yeah. The number one question that we have received from clients, and I bet you're getting it from subscribers as well, is will we have a recession soon? And another way to phrase that is, can we as a country thread the needle such that the Fed is able to tame inflation without crashing the economy?
Yeah, I don't think so. I don't think the Fed has that ability. I think that they're way behind. I looked at the cabinet now and the Fed governors. None of them has ever had a job outside of academia. That to me is bizarre. Like, that to me is a lack of understanding. I don't think they'll be able to figure out how to tame inflation per se, but businesses will and capital will, and hopefully by more factfulness and truthfulness in discussions, we'll start spending stuff on true investments and not control of other people. But that's my libertarian bent coming in. But I think we're right at the cusp of, and the productivity and the channeling downward over time suggests recession coming. I don't think it's going to be 20s depression where we get deflation. But I think inflation could come back pretty quickly and pretty soon. You know, I think Russia, Ukraine, that sort of popped up food prices a little bit, but a lot of that was starting to happen even before that happened. And so it would be a mistake to imagine food and that part of the world and energy is critical to that happening. I think you just have to look. I was reading today, New York State, the shale there has got something like, hundreds of millions of barrel equivalents of energy under the ground, and they won't allow fracking. They won't allow anyone in New York State to pull that up, and that to me is crazy. Mm-hmm. So I'm not helping you.
I'll provide just a little bit of different view based on what we see with some of the positive economic leading indicators that you showed. Incredibly powerful employment data, where there are now more than 2 job openings per job seeker. I actually do think I do not foresee a recession in 2022. I think it's too early to call.
Yeah.
Too many things could happen in 2023 to derail the economy. The tail risks are very, very high.
Yeah.
I
wouldn't fight you on that.
You wouldn't disagree with that?
No. I mean, I would be 55-45 for recession, and I truly believe in the country and the world that will be able to manage it. I think China will. There's a new leader that's probably coming on board there who's maybe a bit more receptive to global trade and less control. So I could see that. I wouldn't fight you on that.
Yeah. I mentioned it in my presentation a little bit, but billionaire investor Ray Dalio says that the holy grail of investing is adding uncorrelated assets to your investment portfolio. In this day and age, so many assets are so highly correlated. And for instance, it used to be when your stocks went up, your bonds kind of held in there. When your stocks went down, your bonds increased in value. But with low interest rates, you don't get that. And in fact, everything is pretty correlated. I guess my question, I think I know the answer. So we agree with that at Stansberry Asset Management. We find ways to add less correlated assets to our mix. One of those is merger arbitrage investing, and clients know what we're talking about, but happy to talk about that a little bit later. Based on some of the things that you do, I'm guessing you agree with that, but I just wanted to see.
So merger arbitrage specifically, when I launched the letter, it was a little bit, we did, I think my second or third letter, we did a merger arbitrage, a couple of plays.
Oh, you did?
Yeah, and it was probably a little advanced for folks, in my retirement millionaire letter, where the back half is about health stuff and the front half is meant to be a little more easygoing. But the trades were simple, buy the company that's being bought because you think here's the price, it's going to go to 100, and so I love it, and it's definitely a strategy that I like. So,
but I think more routinely you're employing selling options, where you're in the volatility, the premium you get from those options is greater when the world gets a little bit worrisome.
Yep. And to your point about uncorrelated assets, that's what my team, and we spend time searching for that all the time. We've had a salmon fish farmery in there. We've had some funny, strange, unusual assets that that are uncorrelated to the overall market for sure. Yeah. That's how you get on that so-called efficient curve where you maximize your return relative to risk. Yeah, love it.
Notwithstanding your...
It's actually great. It's fun for me to be up here knowing you from working with us and knowing that you're actually applying that and talking about it.
Yeah.
That's fantastic.
No, it's great. I watched your video with Jeff that you guys put out just yesterday.
Right.
It was great. Let's see. You mentioned a little bit of a negative bent, perhaps, towards cryptos, but just want to get your latest thoughts on gold, Bitcoin, and all other cryptos. If we could separate those into three categories.
Gold,
Bitcoin, and then non-Bitcoin cryptos.
Yeah, so all of those assets they aren't doing anything other than you're depending on the next person to buy it at a higher price for you to make money. Other than gold has this characteristic that has stood the test of time for hundreds, thousands of years. So of those three, gold is the one that I would use as a store of value over long periods of time. So I've always had a little bit of gold, a little bit of silver, and it's varied over time. In fact, about the moment that Kiplinger Finance article came out, Matt and I, we modeled this and we said, okay, get out of bonds, put a lot of your portfolio into gold. It was in one of our income intelligence issues, and we're killing it. That portfolio move, or however much you put in that trade, is fantastic. So yeah, cryptos on the other hand, I mean, like, I don't get it. I won't get it. I sat next to a guy on a plane. He's divorced. He had 12 cryptos. He sold 3 of them. He has 9 left. He's asking me whether to sell. I'm like, sell, man. What can you get for it today?
Yeah.
Because it's like in the NFT world, there was that painting that went, I think, bought a couple years ago for
70 million or something like that.
70, right?
Yeah.
Yeah, and sold. I mean, now it's nothing. So
yeah. So I tend to agree with you on the two ends. Gold's a great store of value, I think. Not a productive asset, but a great store of value. It should store value better than the dollar. One of Porter's examples is if you had bought a nice suit in Savile Row 100 years ago, it would have cost you about $20. And if you'd buy one now, it costs you about $2,000. But in gold terms, it would have cost you an ounce of gold back then, and it cost you about an ounce of gold now. So clearly it's been a better store of value. I think that Bitcoin has an opportunity to be that digital store of value. If folks embrace it, it has a first mover advantage. So I'm positive on that. It's going to be more volatile, and it's not something that you should put a lot of your money in. I'm way more cautious on the rest of the crypto world. And there's this thing, and I apologize for clients so we're gonna, sorry, I'm getting told we maybe want to get to cocktails soon. So I'll stop with that analogy. I'll save that. But let's just do a couple more questions. Sorry, Vanessa, we're going a little over. Any burning questions from the audience? We'll have an opportunity to talk to them, but if you think it's more valuable for the whole audience to hear. Yes.
I'd like you guys to share some insight into this market volatility when the story.
You want to take it? You want me to take it?
you can start.
So
I'll see how you do. I'll judge it. I'll determine whether or not it's worthy of this crowd.
Yeah, yeah. I think it's very hard to create, even though the pundits on CNBC do it every day, it's very hard to create a true rationale for one day's move. It's just, the market is trying to understand the long-term value, and it takes little nuggets of information and tries to ascertain long-term value based on that. So you see these gyrations. I don't think that's, it's tough to sort of figure that out. Over the longer run, though, markets tend to figure it out. And look, you've identified some of the bigger issues. And I will say, relative to where we were in November or October to now, everyone's expectations for inflation have gone up, and it's higher for longer. And so inflation it's not just about the current day numbers, it's also about expectations, because it impacts folks, companies and investors and just regular folks, what they're going to do with their capital and their investments. If they're worried about inflation, they may not invest as much, so it has a dampening effect on the growth. Back then we weren't as worried about China or Ukraine, or the Russia-Ukraine, obviously. So things have gotten worse. Outlook for growth is lower. So it makes sense to me that the market has, over that period of time, sold off.
Yeah, my answer relates to that chart that I put up about margin. At the point in the peak a couple months back, super highly leveraged market. It just a lot of people using their brokerage accounts and their ability to lever that trade, and if that starts to go south, you get a margin call and it could go south quickly. It doesn't mean the world's coming to an end, but I told you, I mean, I threw that snake at you. Was that the safe snake or the one that's going to kill you? You don't know. So when it starts to move, if you're levered, you pull out your gun and you shoot it. Thank you. It was kind of a Texas joke. Sorry.
All right. So so we'll take one more question, then I'm going to finish a question, and then we're going to go to cocktails, and you can ask us all the questions. You're going to stick around for cocktails and answer some questions?
Sure, absolutely.
Yeah. Great.
So my question is, when do you think the zombie companies are going to start falling?
Yeah, that's interesting. One of my favorite conferences in the world is going to be virtual again this year. It's the New York Society of Security Analysts. This year will be the 32nd High Yield Bond Conference, and it comes up in June. And I'll be able to better answer that after that, because, the cliff, a lot of these companies got it out far enough. The cliff being when the debt is due and they have to roll it over again. It's still a couple of years out for a lot, the big bulk of it. So we could slide for a year or so, at least. Anyway, I can't wait for it, and I wish it was real, because you get to, in person, you get to learn stuff that you would never learn over a Zoom call.
Our calculation is that the number of zombie companies is a little lower than what Stansberry Research calculates. There are many companies that have lower earnings than their interest coverage payments that have unencumbered assets as well. So they can kick the can down the road by utilizing those unencumbered assets. But we're a lot closer to having some issues as interest rates rise. So there's big refinance risk for a lot of these companies. There's convertible bonds that many companies were doing with 0% interest or near 0% interest, with the idea that you could also get a upside if the stock went up. Those companies are really going to struggle to refinance, and so we're going to have interest rates are now getting up to where bonds are more interesting to us. But the reason that we're not invested more is that other piece. It's the default rates are also rising that we're concerned about. Great. Okay, last question. Porter says everyone who follows Stansberry Research should still hire a money manager as long as it's the right one. What are your thoughts on that?
How do I do this in the most diplomatic way? I'm really happy you're in this spot. When you have clear glasses, you see a lot of stuff. I know that from working with you. So I'm super excited. So
great.
Anyway.
All right. Well, listen. Thanks so much, everyone. Thank you, Doc, for being here. Thanks, everyone, for coming. And let's enjoy some cocktails and get to know each other a little better.
Thanks.
Thank you.
Thank you.
Stansberry Asset Management, SAM, is a registered investment advisor and fiduciary that puts clients first, providing access to opportunities and tools usually reserved for institutional investors only. Our focus is on the long term. We believe in exploiting the power of compounding over time. We favor high-quality businesses with enduring growth prospects. Risk management permeates all that we do. We are relentless in seeking asymmetric reward-risk ratios that tilt in your favor. We believe asset allocation is crucial, individually tailored to meet your needs, not fixed to traditional Wall Street standards such as investor age. We diversify across global asset classes, creating portfolios that are resilient regardless of economic conditions. As multi-asset class investors, our opportunity set includes equities, credit, distressed credit, precious metals, commodities, cryptocurrencies, real estate, and more. And SAM is an active manager. Depending upon conditions of value, liquidity, and sentiment across asset classes, portfolios are rebalanced regularly. As a SAM client, you can count on us to avoid conflicts of interest, know the investments you own and why, invest beyond traditional markets, offer unparalleled client service, and provide complete transparency. To meet your diverse needs, SAM offers 5 primary portfolio strategies: income, all-weather, total alpha, forever, and our newest solution, venture growth. Stansberry Asset Management.